Calnex, they came up with results, and these were on my watch list, but it's a recovery play, and I think it's going to take a lot longer to recover than I thought. So what do? It designs, produces, and markets tests and measurements, instrumentation, and solutions for the telecommunications and cloud computing industries. So listen, they've taken a hit because apparently there's been a downturn in spend in the telecommunications area. But they're launching new products, apparently, and they also should benefit from AI, because, of course, there's more, processing power needed, more computing power needed, more connections needed, all that kind of stuff. And so they supply the equipment, tests all those connectors and stuff, So it may be a recovery play, but as yet, there's no signs of it. And I did like this company because the margins were good, and it was a decent business, but it's taken a bit of a hit. But like I said, can it get back to its former glory? Let's have a look. So share price, 52 pence. Target, 1.3. So that's 103. That's 98% upside. That's what the brokers are saying. Brokers can, and I think they've brought that down a little bit. So, be careful with brokers' targets because they can change them. Anyway, market cap 45, 33 million. Again, in the green, that's good. More cash than debt. Net asset per share. Again, liquidity is a bit low. Average daily volume 60 grand's worth. Revenue 16 million. So straight away thinking that's several times, sales. Market cap is several times sales there. They made a loss. Ooh, cash 11.8 though. No debt. I like that. Operating cash flow 7. Free cash flow. Are they investing in something or paying a dividend? Or they do pay a dividend. Cut the dividend. If you start making a loss like that, just cut the dividend. If I was a CFO, I should cut the dividend. We're making a loss. They're not paying the shareholders. They can hang on in there if they believe they up. To be honest, there's capital upside you want in small cap companies. Just cut it until we start making a profit again. So let's have a look at the scores here. So there's some red going on here, isn't there? Growth is dead. Red. Momentum, dead. Total value. Okay, there's a little bit of value there. Health is good. Efficiency is not good now. The potential is good. But potential, remember, these are the most important metrics: growth, value, momentum, in that order, pretty much. Okay, look at that. 0 point, 0 point, 0 point. And these are all, in fact, these are the latest results here. It was a half year results, I think. Oh no, 31st and 24th, sorry. This is recent results. So this is up to the 31st of March. So 2.8 times sales, price to earnings, 1,127. It's a bargain. Wow. Okay, let me give it. But that profit, I assume, was because of a tax rebate, maybe. But EBITDA 7, not too bad. The price free cash flow, health is good. They've got plenty of cash there. And if, like I said, margin, like I said, the margins on this previously, gross margins 73%, decent, but now they make it a loss. Share price is dead in the water, but the broker targets are looking extremely good. Now, if you look at this going back, the forecasts, like I said, they had 21% net margins. That's why I think you should keep an eye on it. In fact, I shouldn't, sway your judgment here. Sorry. But I did note that the forecast top line growth has been revised down. And so they're saying that they will get 15, 16, which is not bad growth, but I think they could come down a bit further. I think there's more. That's why I quite like companies. The previous companies are quite good. They can take a big knock and take a long time to recover. And when they become a recovery play, like I said, they've been knocked so much because they've been downgraded and the growth hasn't come, that they can then, if they show signs of recovery, can really rally. And so I think, well, obviously, margin's good. As I said, loss here, but they're saying they're going to go back to, back to a little bit of a profit next year. And then it starts to really ramp up a little bit here. We're going from 2.3 pre-tax profit, the margin 14 margin. So saying, so getting back to almost these levels the next couple of years, hopefully. But again, there's a forecast. It's like trying to predict, the weather. The further out the forecast is, the less accurate but nevertheless, value seems to be okay here. What have I got? I got 44%. These are my sort of based on broker forecasts. I give multiples here, and I go 2 times sales, 10 times EBITDA, 15 times post tax. I'm getting average of 44. Okay. Anyway, here we go, ladies and gentlemen, the jury of the watch list jury. Is it coming onto your watch list? Graham, guys, yes, watch, but not yet. 2025 sprint in the same area, but had terrible results, but have been bought out. Yeah, oh, hey, there we are. If you start seeing the volume go up crazily. In fact, Ramsden's will be covering a bit. Volume this week has been nuts. Absolutely nuts. It's been like 5 times the average daily volume. It's just hardly moved around. I don't know what's going on with it. Sometimes you can't tell. Rob, no, more likely to go down further. In fact, let's look at the chart. Sorry, I do apologize. How remiss of me. Sorry, let's have a look at the chart here. Calnex, come on, look at that. Ooh, look at it from the IPO back here, October 20. It was like 48 pence, up to 190, and now it's come back down here. It's worth them researching these. They're launching more products they think will be more beneficial to the new age and generative AI and all that stuff. So having said that, there's more cost, isn't it? More products. So it's worth coming out. I think it's worth coming out, but I think it could get cheaper. I think it should get cheaper, actually. But yeah, that's, you can see there, under the 200-day moving average. In fact, it's tried to break up fake breaks of the 50-day moving average and failed. This is why sometimes if you're going to take an investment on a break to 50-day, it's essentially use 20% stop loss, because then it's come down here, broken up, and you've been almost 40% up because I moved your stop loss up to 20% there, and then you'd have made 20%. See, if you didn't have stop loss in, there you go, back below where you bought at. But anyway, there we go. Select alert, no watch list before alert triggered. Okay, that, yes. Put alert on it. Well, in fact, yeah, that is, you can see it's a little bit of liquid because it's quite bitty, this chart is. But to me, I mean, I quite like to bring alerts on the moving averages, because they are dynamic, they move. And you can see here, the moving average 200-day has to start sort of bottoming out. It's still going downwards. And it'll only bottom out if this share price stays at this level. So, like I said, if you want to put an alert on the moving average, right click. This is on Trading View, add alert, and then hit the price there. Moving average 50, for example, and put CLX. And I've done it there. Just you don't have to put anything in this box if you don't want to, but I like to put something in there. And then same with the 200-day moving average. But yeah. Daniel, Calnex, no. Brian, no. Paul, yes. This looks like a good one for the watch list. I think it is. It's on my watch list. I think it's going to take a long time. I think it's, I mean, recoveries can take anything from months to a year or so, maybe. Remember, they tend to start recovering before financial results come out. Trading updates are always a good sign of that. A trading update, the preview of the interim results or full year results, and then it start a rally. I'm in for recovery with a 20% stop loss. Mark, you're in already. You wait for the uptrend, fellow. That's to me, that's not finished a downtrend yet. Be careful, very careful. Ed, Silex, no, better options elsewhere. Daniel, Spirit is Calnex's biggest customer. Is it? That's very interesting, Daniel. Calnex, yes, still good company. Sector problems will improve, and then surely this is a good recovery play. Yes, that's it. When you look at recovery plays, you have to understand, and I talk about this in the blog, by the way, recoveries and performers. Is it sector specific, the problem with their business, or is it company specific? Because that's more serious. If it's company specific, how are they going to sort it out? If it's sector specific, then it's when the sector recovers, it'll recover with it. Like I said, if you look at the margins previously, it seemed like good business. Will they get back to that? Hopefully. So there we go. Okay, that's Calnex. I'm saying, for me, generally, I think members of the club say no. For me, I say, yay. One for the watch list. It's going to be a recovery. I think bit of confidence it will recover. The question is when. And that's why, you just put on the watch list, receive the RNSs, read the news, and there we are, and see where it goes. But again, it's just time. It's building up a few of these decent companies on your watch list. And that helps sometimes with FOMO, because you won't have just one idea and think that's the one. Because there isn't one, there's lots of opportunities, And so, and if you think there's only one, you'll tend to go too big on it. And then if you start going the wrong way, you're in trouble. So when you have lots of ideas, it tends to help with FOMO, because there's not one, there's plenty.